Short exercise 8-8, bank reconciliation. So here's my simple explanation of bank reconciliations. We compare the monthly bank statement to our company's cash account to see if we are missing any transactions. The most commonly missing transactions are interest revenue, bank service charges, non-sufficient fund checks received from customers. That means a bounce check. Customer did not have enough money in their checking account when they wrote us the check. So the bank is now taking that money back from us. That's what an NSF check is. And these are the most commonly missing transactions because we are not aware of these transactions usually until we get the bank statement. Also, during a bank reconciliation, you look for errors in your accounting records or on the bank statement. And if you are missing any transactions, you then need to enter them into your journal. And if you made any errors in your accounting records, you're going to correct them in the journal. So let's get to this problem. The cash account of Safety Security Systems reported a balance of $2,450 at the end of December. Now notice this bank reconciliation, we have two sides. We have the bank side and we have the book side. Book means the accounting records of the company. Remember, accounting records used to actually be in books. Now they're electronic. Getting back to our review from the previous video, on the book side of the bank reconciliation, which represents the company's accounting records, we're going to enter any transactions that the company did not know about, such as bank service charge, interest revenue, electronic funds transfers, etc. And then up here on the bank side, we're going to enter any transactions that the bank did not know about, such as outstanding checks and deposits in transit. And then later in the next homework exercise, we're going to enter the transactions that are missing in our accounting records, and we'll enter them in the journal. So again, back up to here, the cash account of Safety Security Systems reported a balance of $2,450. So when we go look at our ledger, it says our cash account is $2,450. And then as we're looking through the bank statement, we find the following information, or the following data points. There were outstanding checks totaling $1,700. Well, what's an outstanding check again? That's when our business writes a check, immediately deducts the amount from our cash account via the journal, which is then posted to the ledger, but the bank does not subtract the check until it's cashed, often several days later. This is called an outstanding check. This is a check issued by a company, our company in this case, and recorded on its books, our accounting records, but has not yet been recorded by the bank because the recipient of the check has not yet cashed it. Okay? So we wrote a check, or maybe multiple checks, totaling $1,700. We entered them in our accounting records, but they did not show up on the bank statement. So we have to enter these outstanding checks on the side that did not know about them. So who did not know about them? The bank or our records? Well, the bank did not know about them. Then we have to make a decision. These checks, would they be added to our cash balance in the bank statement, or would they be subtracted? Because these are checks we wrote, they would be subtracted. So we're going to put them on the left side. Outstanding checks, $1,700. And there's also a December 31st deposit in transit of $300. So what's the deposit in transit? Let's go back to the information from my previous overview video. A deposit in transit is a deposit recorded by the company. In other words, that's us. We record it in our cash account. But it does not appear on this month's bank statement because the deposit was made as the bank statement was being printed. So these deposits in transit are deposits we made towards the end of the month that didn't make it in time to be printed on the bank statement. So we had to put this deposit in transit on the side that did not know about the transaction. So who did not know about the transaction? The bank or the book? Well, we already put it in our accounting records. So these deposit, or this deposit in transit, has to be put on the bank side. Now, since it's a deposit, we have to add that to our cash account. So we're going to add that $300. Next, the bank statement, which came from Park Cities Bank, listed the December 31st balance of $4,460. So as you can see, the bank says we have $4,460. Our cash account says we only have $2,450. So this bank reconciliation process is finding out why there are differences and then reconciling them so that we come to the same balance on both sides. All right, let's see what else is next. Included in the bank balance was a collection of $620 on account from Brendan Ballou. So on the bank statement, it shows there is a $620 collection on account from our customer, Brendan Ballou. And this customer pays the bank directly. So we did not know about that. We do not know about this collection because the bank collects it for us until we get the bank statement. So the bank statement already shows this, but our book side, in other words, our accounting records, do not show this. So we have to show this $620 collection. And since we are collecting the cash, we're going to put it under the add. So bank collection, and it's for $620. The bank statement also shows a $20 service charge. So the bank statement shows a $20 service charge, so it's already on the bank side, but we have not entered this $20 service charge on our accounting records. So we have to put it on the book side, which is our accounting records. And since it's a service charge, we're going to put it under less. We're going to have to subtract that. $20. And there's also a $10 of interest revenue that appears on the bank statement. We did not know about this, so we had to put this $10 of interest revenue on our side, the book side. And since we are receiving the interest revenue, that's under addition. So let's see here, interest revenue, $10. And that's it. So now all we have to do is math. So we're going to take $4,460 plus $300 gives us a subtotal of $4,760. Now we're going to take $4,760, subtract $1,700. Actually, here we're going to put the total of this $1,700. So just put the $1,700 again. And just remember, we're subtracting this. So $4,760 minus the $1,700 gives us, what is that? $3,060. Okay. So now when we're done with the book side, we have to get the same balance. Otherwise, we're missing something or we've made an error. So now let's do the bank side or the book side. We got $2,450. Well, first of all, we have to add these two up. $620 plus 10 gives us $630. So now we're going to take $2,450, add it to $630, gives us a subtotal of $3,080. And now we have a charge of 20. Let's bring the charge over. So we're going to take $3,080, subtract this charge of 20, gives us $3,060. So what this means is the amount of money we really have in our cash account is the $3,060. So the bank wasn't technically accurate, and our cash records were not. Our cash account was not technically accurate. We said we had $2,450, but we actually have $3,060 because we did not know about this transaction, and this transaction. So in the next problem, what we're going to do is in the journal, we're going to enter these three transactions that we did not know about. And that's it.